Welcome to this lecture on issues in tax planning and administration. In this course, we will critically examine the principles, practice, and theory of the Nigerian taxation system. We will cover income tax, surtax, corporation tax, and capital gains tax, as well as their application to individuals, partnerships, and companies. This first module focuses on building a strong foundation. We will begin with the principles and theory of taxation, then move to the Nigerian context, its income tax system, corporation tax, surtax, and capital gains tax, before finally exploring computations and assessments for different taxpayers. Section 1. Principles and theory of taxation. Taxation is one of the oldest tools governments use to raise revenue for public services, infrastructure, and development. It is also a tool for wealth redistribution and regulation of economic activities. The core principles of taxation include equity. Taxes should be fair, with individuals contributing based on their ability to pay. Certainty. Taxpayers should clearly understand how much they owe, when, and why. Convenience. The system should make tax payments manageable and practical. Economy. The cost of tax collection should not outweigh the revenue raised. Modern tax systems also emphasize transparency, accountability, and alignment with broader economic policies such as industrial growth, social welfare, and foreign investment. Section 2. Overview of the Nigerian tax system. Nigeria operates a federal system of government, and taxation powers are shared between federal, state, and local authorities. Federal taxes include company income tax, petroleum profit tax, value-added tax, capital gains tax, and customs duties. State taxes cover personal income tax on individuals, road taxes, and business premises levies. Local governments impose rates such as tenement rates and motor park levies. The Federal Inland Revenue Service, FIRS, administers federal taxes, while state boards of internal revenue manage state-level taxes. Section 3. Nigerian income tax. Income tax is central to Nigeria's revenue system. The Personal Income Tax Act governs taxation on individuals, partnerships, trustees, and executors. Key features include: residents are taxed on worldwide income, while non-residents are taxed only on Nigerian-sourced income. Allowances, reliefs, and exemptions exist to encourage savings, investment, and fairness. The progressive rate system ensures that higher earners contribute proportionally more. Section 4. Corporation tax. Corporation tax in Nigeria, also known as company income tax, applies to the profits of incorporated businesses. It is governed by the Companies Income Tax Act. Important aspects include: tax is levied on worldwide profits of resident companies and Nigerian source profits of non-resident companies. Deductions are permitted for expenses incurred in generating taxable income, such as salaries, rent, and utilities. Certain incentives, such as pioneer status and investment allowances, encourage industrial growth and foreign investment. Section 5. Surtax and capital gains tax. Surtax refers to an additional tax imposed on certain categories of income or taxpayers, often as a temporary measure to boost government revenue or to address inequality. Although not as prominent today, surtax has historically been used in Nigeria in times of fiscal pressure. Capital gains tax applies to the disposal of chargeable assets, such as land, buildings, or investments, at rates determined by law. Exemptions exist for certain transfers, such as those between spouses or as part of a deceased estate. The aim is to ensure equity in taxing wealth accumulation. Section 6. Computation and assessment for individuals, partnerships, and companies. Tax computation involves determining total income, deducting allowable expenses, applying reliefs and allowances, and calculating the tax payable under applicable rates. Individuals, personal allowances, reliefs, and progressive tax rates shape their liability. Partnerships, tax is assessed not at the partnership level but on each partner's share of profit. Companies, liabilities are calculated after adjusting profits for allowable and disallowable expenses, depreciation, and incentives. Assessment may be self-assessed, government-assessed, or based on estimated income where records are incomplete. In this first module, we examine the principles of taxation, the Nigerian tax structure, and specific taxes including income, corporation, surtax, and capital gains. We also explored computations and assessments for individuals, partnerships, and companies. In the next module, we will turn to the administrative side of taxation, claims, appeals, international aspects, and contemporary issues in Nigerian tax administration.